Hi everyone. Today we are going to discuss the basic concept of capital budgeting, and further we are also going to discuss its types and techniques in detail. Now let us first understand the basic meaning of capital budgeting. See, a company or an organization has to perform various functions like where to raise the finance from, okay, and further where to invest that finance, okay, that is which projects to choose from various projects so that the efficient utilization of the finance happens, okay. So it is basically the process of planning where to invest the capital outlay so that efficient utilization of the finance happens, and it includes both raising and utilization of long term funds only, okay. So the point to remember over here is that it includes just the long term funds, okay, like debentures, okay, your bank loan which extends for more than 5 years, okay. Now let us discuss the various types of capital budgeting. The first one is accept reject decisions. Here the thing is we have just one project, okay, and we have to either accept that project or reject the project. So the question is, how do we do this, okay? So we first need to understand the cash flows that we are going to receive from that project. Let's say I invest in a machinery of 1 lakh rupees, right? And I expect that it will be giving me a cash inflow of 10,000 per year, okay? So I will be receiving the amount in 10 years, okay? So here what am I supposed to do now? I will be discounting the cash inflows. Remember, cash inflows, that is 10,000 per year. I will be discounting them through a discounting rate, and I will be finding out the present value of the cash inflows. Then what am I supposed to do? I will be subtracting it from the cash outflow, which was of 1 lakh, okay. If the value is positive, okay, if the net present value is positive, then I will be accepting the project. Now the next one is mutually exclusive decisions. Here the company has two projects, right? It has to choose one out of two. So it will find out the present value of both the projects, okay, the cash inflow present value of both the projects, and then it will be subtracting it from the outflow, and the project which will be having the highest value or more value of net present value rather, then that project would be accepted. The third one is the capital rationing decisions. Here there are huge number of projects that a company has to choose from, right? And it has to choose just one project. Now let us discuss the various techniques of capital budgeting. So basically it is divided into two techniques, non-discounted techniques and discounted techniques. So what are non-discounted techniques? See, we are using discounting factor, okay, discounting rate to discount the cash inflows that we are getting every year or annually. So non-discounted techniques are concerned with not using the discounting factor, okay. And when we talk about discounted techniques, we use the discount factors, okay. We will be using a rate to discount the various cash inflows that we are receiving from a project or a cash flows annually, right? Now let us discuss the various types of non-discounted techniques. The first one is the payback period, the time in which the cash outflow is paid back to the company, okay. It is the payback period, simply the time, okay. So how do we find it? For the even cash flows, okay, where there is similar cash inflow every year, okay. So the formula for this is in initial investment upon annual cash inflow, okay. So initial investment is, let's say, 1 lakh rupees, so we have to divide it by annual cash flows, which is 10,000. So I will be receiving my amount in 10 years, okay, in this way, by this formula, okay. Then the second type is average accounting rate of return. Okay, we have to find out what is the rate of return from the project, and that is average rate. Okay, so the formula for is average annual profit after tax. Okay, we know how do we calculate the after tax. We have to subtract the sales from your all the fixed cost and variable costs that we incur, then we find out the operating profit, and then we pay various taxes. Okay, and we come to know the average annual profit rather after tax, right? Then we have to divide it by average or initial investment, how much investment we have done. Okay, 1 lakh let's say, and we have to average it, and we will be dividing it by average annual profit after tax. Okay, so in this way we find out the average accounting rate of return for a particular project. Now let us discuss the discounted techniques of capital budgeting. Okay, so the first one is net present value. See, net present value is basically the difference between the value of cash inflows. Okay, that is the present value of cash inflows and the cash outflow. Let's say I have invested 1 lakh rupees, that is the cash outflow, and cash inflow is 10,000 that I'm getting every year, but I have to discount it. Okay, we have to find out the present value through a discounting rate. So in this way we will be finding out the net present value. If the present value is positive, then we will be accepting the project. Okay, now the next technique is profitability index or benefit cost ratio. Okay, so here we basically find out the profitability of a particular project. Okay, if the index is more than 1, then we will be accepting this decision. So what is the formula for this? Present value of cash inflows, right? We have to discount the cash inflows, okay, through a discounting rate, and we have to divide it by the present value of the cash outflow. Simply, if we divide both of them, then we come to know whether the project is profitable or not. Okay, so profitability index tells us whether a project is profitable for us or not. If it is more than 1 the value, then we will be simply accepting the decision, right? So now the last one is internal rate of return. See, it is a rate of return at which our present value of cash inflows is equal to a present value of cash outflows. Okay, so it is basically the point at which our net present value is 0. Okay, so internal rate of return basically tells us that whether to accept or reject a project if the value is equal to cash outflows, that is the present value of cash inflows is equal to present value of cash outflows, we will accept the decision, right? So these were all the techniques of capital budgeting. Okay, so what did we discuss today? We basically discussed the meaning of capital budgeting, which is nothing but the decision to invest in a particular project or not, okay, through the use of various techniques. Okay, then we discussed the types of capital budgeting. The first one was accept reject decision, where we had just one project and we had to decide through net present value whether to accept it or not. Then mutually exclusive decisions, where we had two projects and we had to choose one. Then the last one, capital rationing, where we had to decide from many projects which one to choose. Okay, and we used net present value to find out the same. And further we discussed the various techniques of capital budgeting, like non-discounted and discounted. Non-discounted is without the discounting factor, and the discounted one is with the discounting factors, right? So there were basically payback period method in the non-discounting, then average accounting rate of return. Okay, then in discounted we had net present value. Okay, the most famous one, the most common one is net present value. Okay, then profitability index to find out whether the project is profitable or not. Then finally the internal rate of return, where the cash flows of the project present values and present value of cash outflow is equal. Okay, now let us discuss various questions. So the first question is, capital budgeting is used for A. Capital structure decisions, B. Investment decisions, C. Dividend decisions, D. Philanthropy. See, we all know that capital budgeting is basically concerned with the investment part. So we basically take the decision of whether to invest in a particular project or not. So it is basically concerned with investment decisions. The second question is, under which method of capital budgeting the future cash flows are discounted? A. Discounted payback, B. Profitability index, C. Net present value, D. None of the above. See, we all know that net present value method is basically used to discount the various cash inflows, okay, that we receive annually. So the correct answer for this question would be net present value. So this was all for today. Thank you so much for your time. See you soon. Bye bye.